As 30-year fixed mortgage rates hover near 7%, home prices rise, and market uncertainty remains, there may be some new opportunities and potentially some risks investing in mortgage-backed securities. We're going to discuss why these assets are in focus, what the risks and opportunities are, and what to be on the lookout for. We're going to break it all down for you right now on UBS Trending. Hi everyone, and welcome to another episode of UBS Trending. I'm Anthony Pastore. Thanks for joining us today. My guest in the studio is Clayton Trick, the head of portfolio management and public strategies at Angel Oak Capital Advisors. Clayton, good to have you back in the studio.
Anthony, great to be back.
Yeah, it's an opportune time for you to join us because today we're talking about mortgage-backed securities, which is part of the fixed income asset class. And right now in UBS on our CIO, we have an attractive view on agency mortgage-backed securities given where spreads are. Before we go into all the details, and you talk to clients and advisors all the time, when you talk about the spreads, the widening spreads within MBS and the asset class, what is it that makes that so attractive for an investor?
Absolutely. So yeah, we would completely agree with Leslie Falconio's view that agency mortgages right now are attractive. Spreads are high, and what that really means is the additional yield, the additional income an investor gets investing in the agency mortgage market is higher, is elevated above treasuries. So that additional income really sticks out right now, which is why investors find it quite attractive.
Right. And is there more risk involved when you're, widening credit spreads? Obviously, you're getting paid as an investor to take on certain levels of risk. What's the risk right now with MBS?
So we think the market's actually pricing pretty well right now is the timing of cash flow is risk. So agency mortgage investors, right? What are you getting? You're getting paid an income stream, and there's uncertainty when that borrower in that mortgage is going to refinance. Are they going to refinance in a month? Are they going to refinance in 25 to 30 years? So that uncertainty of the timing of risk, or the timing of prepayments and timing of cash flows is what gives you that additional yield. What's really interesting today is the reasons why the mortgages are cheap is not really the fundamental reasons, it's the technical reasons. And so a lot of buyers typically in this market are not in it like they usually are. And so that allows other investors to take advantage of that and get that higher yield.
Right. And as a definition, and this is probably like from Investopedia, as I explain this, you're looking when mortgage-backed securities they are essentially instruments that are secured by mortgages or a basket of mortgages, residential mortgages, commercial mortgages. In this case, though, we're looking at, the uncertainty around the markets itself. Before we get into that, because we're going to talk about the Fed in a moment, I want to ask you about that. But when you look at, for example, where mortgage rates are at 7% or so, but we were just talking that a lot of mortgages, a high majority of mortgages, something like 85% that exist in the US today, are below 3.5%, because most people who are owning their homes from early in the decade or 2000s have refinanced.
Right.
How does that affect the value of a mortgage-backed security, given that so many mortgages are at 3 to 3.5%?
Yeah, that's really where we see a lot of opportunity.
Right.
And so everyone talks about where they can get a mortgage today. It's 6.5%, 7%, as you mentioned, but the majority of mortgages are outstanding at the average rate's 4%. That's the largest gap between the new mortgage rate you would get and the outstanding rate, the largest gap we've had since the early 80s.
Yeah, wow.
That's been a huge driver of low turnover, right? So individuals in their homes, just like you mentioned, not wanting to move, not wanting to upgrade their home, not wanting to move to a different city because they don't want to give up that low mortgage rate. So they're sitting in this low payment. That's been great for homeowners, homeowner credit. As inflation has risen significantly, rents have gone up significantly. That borrower is sitting in a low rate. So they actually have benefited from home prices going up, but their cost of funding is not going higher because their mortgage rate has stayed so low.
Right.
We really like discounted mortgage-backed securities in this market, actually buying those mortgage loans that are that 4%, 3.5%, 4% rate that all came out in 2020, 2021 when rates were low. We see that as actually one of the best opportunities to actually be a bond buyer.
Yeah, and again, considering, like we said, there's a high majority of them out there, there's a lot of opportunity. Given though that there are some tailwind risks out there, we here at CIO expect the Fed is going to start cutting in September, and as of right now, say it's going to be about 100 basis points between September and sometime in mid-2026. Given that there's still uncertainty about where markets are going with tariffs, given uncertainty about what the Fed might or might not do, does that impact, or is that a headwind for mortgage-backed securities at this point?
Well, the market's been pricing it pretty well. So that is really one of the main drivers of why mortgage-backed securities are so cheap right now. It's because there's who knows when the Fed's going to move. I mean, we actually agree with your CIO's office that we could see the cut happening later this year, with more cuts happening in 2026. But with the tax bill on the table right now, with where inflation is going with tariff policy, there's a lot of uncertainty. What does that mean? Interest rates are extremely volatile. When interest rates are volatile, mortgage bond investors get paid a lot of additional yield for that risk. And so it can be a headwind if interest rates continue to rise, but you're being compensated for that risk much more than when the Fed was owning a lot of agency mortgages back in the 2010s. So it's a much better yield environment to actually be taking that risk today than before.
Yeah, and as you said, when you look at the benchmarks, you go out all the way at the end of the curve, you're looking at a 30-year treasury and you're getting paid a pretty high percentage out there right now versus what the 5s and 10s are. But that belly still seems to be an attractive entry point for many, so you're not taking on too much duration risk at that point. What about, you look at sort of like the refinancing idea, and it doesn't seem like a lot of folks are doing that now because rates are so high. What's it going to take for that market to kind of come back, for rates to drop? What is your expectation here?
So there's like two pools of mortgages outstanding, right? There's the low rates, the average 4% rate that came out in 2020 and 2021. And then there's the individuals that got a home in the last 24 months at a 7% mortgage rate. So that 7% cohort, we could see a lot of refinancing if mortgage rates fall to say 5.5 or 6%. It's a low likelihood of happening, but it could happen, right? So 10-year treasury could go to mid-3s. You could see mortgage investors going into mortgage bonds that could bring rates down. So you could see a lot of refinancing kind of pick up. But overall, we do expect it to be quite low. That's one of the reasons why we like those discounted mortgage bonds, because no one's really expecting it. If we have a big drop in mortgage rates, which leads to higher refinancing of the mortgage bond market, those lower coupon pools will really benefit, basically being pulled apart in that type of scenario. But it's going to take a big move in interest rates to have a big refinancing wave, which typically happens in a recession, but there's not that many mortgages that have been originated at that 7% number.
Right, exactly. And looking at the overall market, we've got non-agency, mortgage-backed securities there with a pretty wide spread. What do they look like to you versus corporates right now?
So that's where the biggest opportunity sits, right? And so while mortgage bonds look attractive on a yield basis, on a spread basis, it's really relative to other asset classes. So relative to investment-grade corporates, we see agency mortgages extremely attractive. Again, that's why we kind of really agree with Leslie's view on agency mortgages. We think actually the best opportunity is really in non-agency mortgages. So if you look from AAA bonds all the way down to BB rated mortgage bonds, that spread, that additional yield is extremely elevated. So we think that is really where investors are going to get the biggest bang for their buck. Now, in the non-agency mortgage world, you have default risk, right? You're not being backed by Fannie and Freddie buying a non-agency mortgage bond. However, homeowner credit is really attractive. There's so much equity in individuals' homes right now. We still view the non-agency mortgage market as primarily a timing of cash flows risk as opposed to a default risk. And so, and like you saw in the last 30, 45 days, right? When we saw volatility in stocks post-Liberation Day, and volatility in corporate credit, mortgage bond spreads, non-agency mortgages held up extremely well because most of the bond market realizes that there's very little credit risk in the housing market today, very different leading up to 2008.
Yeah, obviously. I mean, we've asked that question many times in the past. Is this like what we saw back in 2008? And the answer is unequivocally no. I mean, look at the way that, that banks are not just lending money to anybody. You have to have really strong credit quality, and you have to have it backed with enough savings to make sure you can pay for that 20%. Down payment on whatever home you're buying. So it's a very big difference in what we saw back in 2008 and 9, as you're saying. Even in 2010, when I got my first mortgage, it was so strict to get a mortgage. They were so scared about taking. So it's an interesting market to say the least. Yeah. What about so as we kind of prepare we're entering the summer months. And then we go into the fall, and as we said, we don't expect the Fed to do any pivoting just yet. Where do you see the opportunities? Do you continue to see opportunities in mortgage-backed securities? Is it still attractive as we go through the summer? Are there any other opportunities that you're talking to investors about right now?
Yeah, so within mortgages, we like agency, we like investment-grade non-agency mortgages right now. Those really stick out, especially as corporate credit spreads have kind of retraced 80+% of the widening that we saw in April. One other interesting area that I don't think many investors are talking about is really around within asset-backed bonds, within actually auto loan asset-backed bonds. That's an area a lot of investors have been a little more shy within because of higher delinquency rates. But if you look at tariff policy, that's going to probably lead to higher car values, which benefits used car values. So that's a primary key factor within, no pun intended, within auto loan ABS. And so actually higher tariffs could lead to higher car values, which is really attractive for asset-backed bonds. And these are also short duration securities as well. So they have limited impact from like the long end, the 10-year treasury yield moving around a lot. So we think that's actually a huge opportunity that a lot of investors are kind of missing right now.
Yeah. It is interesting. And so hold on to those used cars if you have them. They might increase in value over the next couple of years or so.
Well said.
Clayton, thank you so much. Always good to have you join us. And I'm sure we'll have you back again soon.
Thanks, Anthony.
Thanks
Great
again.
to see you.
You too. Clayton Trick, thank you very much. And thank you to everyone who's watching right now. You can visit our website, ubs.com/views for more insights from our own Chief Investment Office and our great partners. And for more information on UBS, you can follow us on social media. We're on LinkedIn and Facebook, as well as Instagram. Follow us at UBS Trending. Lots of studios content that you're not going to find anywhere else. And as always, if you have any questions about your own portfolio or anything that Clayton and I spoke about today, please make sure you're continuing this conversation with your financial advisor. Until next time, I'm Anthony Pastore. We wish you a great rest of your day. And remember to keep your eyes on what's trending. See you soon, everybody.